How's everyone doing out there? Welcome to the Strategy Room. You are here with the banker next door, Dr. Joe Berquist, your host for 2 hours of action-packed excitement on this May 9th, 2026. So I thank everyone for being here with me on this Saturday night. Obviously, a lot of things going on in the world today, a lot of sports happening at the moment. My Flyers are hanging on by a thread. I think the game is tied right now at 1-1 at the second period. So I'm hoping maybe by the end of the live stream here, I could go check out and hopefully have some good news. Maybe they at least won a game, but we'll see about that. So, but anyway, okay, we got action-packed show here tonight. I have a big AI discussion. Obviously, AI is something I've been talking about a lot in the last couple of weeks. I've really been up on my soapbox talking about how the White House really needs to rein in this out of control monster that they have unleashed. And there might be a little bit of light at the end of the tunnel on that. The White House apparently is beginning to do a little bit of a 180 here on this whole notion of like, let it just go and just let it run free. And now all of a sudden it's like, wait a minute, we might need to pump the brakes here a little bit. So we're going to have a whole AI discussion here later on this evening. We're going to look at a bunch of economic indicators. We got a lot of labor market news this week, a couple other things that came out, consumer sentiment. We're going to take a look at gas prices. What are gas prices doing on everything there? A bunch of different banking news that came out this week. We're going to talk a little bit about M&A, about bank IPOs. We're going to talk about the second bank failure in the U.S. This year. We're also going to talk about the failure of the First Bank of Lindsay, which happened last year. Their CEO actually getting charged with fraud. So we've got a big article there with that. And then just a number of other things. You got Fed updates, banking news, all that good fun stuff we're going to have here tonight. So I hope everybody will hang in there with me for a little while here this evening. But I wanted to kick it off. I'm going to get to our debt chart in just a second here, our debt clock rather. But I wanted to start off with this. This was some huge news this week. CNN founder Ted Turner passed away this week at 87 years of age. Now, I would be the first to say I didn't always agree with a lot of Ted's politics per se, but I would be the first to pass this guy a whole lot of kudos. This guy was an amazing businessman, amazing. So, and for anybody who doesn't know Ted Turner's backstory, so Ted Turner, he grew up in a house. I don't want to say like fabulously wealthy, but he grew up in I think a pretty well-to-do, pretty wealthy house. His father owned an advertising business that basically he did a lot of billboards. And that was how he started it out. And then his father purchased a number of radio stations. And it was at that point that Ted, kind of started working in the business. But then Ted basically took over the business from his father. And then at that point, Ted really, his father had built a nice business. Like I think, might have been doing, 10 or 20 million a year in annual revenue, something like that. So his father had built a really nice business. Nothing wrong with that. But Ted took it to a level that was kind of beyond belief. And at that, this was at the point. So Ted Turner, he has this advertising company that has these radio stations, and then he decides that he's going to get into cable television very early on in the late 70s, the early 80s. And then Ted has the idea that he's actually not just going to get into cable, he's going to create cable networks, cable stations. And he creates CNN, which becomes the first 24-hour news network. And of course, people forget, people take for granted today that we have 24-hour news on with Fox and CNN and MSNBC and all these other channels. But in the moment when Ted did it, when he created CNN, it was a laughing stock. Everybody, all the main networks, ABC, NBC, CBS, they all laughed at him. They all laughed at him. They thought it was a big joke. They all sat there and said, "Who's going to watch news for 24? Who wants to watch news 24 hours a day? And this is, who's going to bother with this? And it's never going to work. And this, that, and the other thing." And then he did it. And then they were all shocked when CNN became the go-to station. And I can still vividly remember as a young teenager when the Gulf War sent CNN into the stratosphere, and that was right around 1991. We get into the Gulf War, which again it lasted for all of like a week, but the CNN was the only one that had live news coverage there during the beginning of the Gulf War when you were just we're just bombing Iraq, and they sent the U.S. Sending the U.S. troops in, and all the other major networks were like scrambling, trying to get somebody over there, trying to get feeds up, trying to do this and that. CNN had the feed live for days, and then they just and all of a sudden it was like people who had never subscribed to cable before got on there and started subscribing to cable in a massive way, just so they could get CNN, just so they could have the news coverage of what was happening. So again, CNN really built throughout the 80s, but it was the Gulf War in 91. Like that was the big moment that just, shot it kind of gave CNN another jump, another, plunge forward. But beyond CNN, he also created so many networks that all of us still watch today: TNN, TBS, Cartoon Network, Turner Movie Classics. That was all Ted Turner. All those stations, all those channels were all created by Ted Turner, and so his impact has been incredible on just the entertainment landscape. He also owned back in the day WCW, World Championship Wrestling. So he had that for a few years and then of course, obviously, you had the major merger with AOL and Time Warner, where Ted basically got bought out, and that's what ultimately made Ted fabulously wealthy with billions and billions of dollars. And then Ted, the kind of the second act of his life, if you will, basically got into buying land all over the U.S., bought millions and millions of acres of land all over the U.S., created ranches, and did all kinds of different things. Tried to do some environmental causes. He opened up I think a string of restaurants, and he had like his big thing, especially up in Montana, where he had a big ranch. They had like the where he grew bison up there. I think he had like his restaurants were known, or may still be known for like their bison burgers and all that. So, but again, I mean, just Ted Turner, just this man was just an incredible businessman, and just made a huge impact in cable television and entertainment, 24-hour news networks, cartoon networks, all this kind of stuff. Just I mean, just an amazing string of success for him over the course of through the 80s and the 90s, and just absolutely incredible. So just so a little bit of kudos there for Ted, for just the amazing. And of course, he did other things too, like he owned the Atlanta Braves, he owned the Atlanta Hawks. Of course, anybody who remembers the 80s and 90s. And then, of course, Ted put all the Atlanta Brave games on TBS, and he would be there at all the games and everything. So a lot of memories on stuff like that. A lot of people remember that, and of course, a lot of baseball fans. A lot of people complained about, because the Atlanta Braves, of course, on TV, and so they basically had a TV deal that no other team in baseball had, and so a lot of people complained about that for a long time. So, but just like I said, just interesting stuff. But kudos off to Ted. He definitely struggled with a lot of illness toward the end of his life, but yeah, what a life, man. What a life. Did just an amazing guy. So. All right. That being said, let's get into our normal program here. Okay, we're going to take a look here at the U.S. debt clock, as we always do, to get started and revved up here. So the U.S. national debt sitting there at $39.2 trillion. That equates to a debt per citizen of 114,000, and a debt per taxpayer of 357,000, because we all just have 357 grand just lying around to pay this off, right? U.S. federal spending is up to $7.1 trillion, with the U.S. federal budget deficit at $1.668 trillion. The debt to GDP is at 122%. Now, that is federal debt to GDP is at 122%. Defense war spending at $937 billion. The interest on the national debt, as I had reported a few weeks back, is now over $1 trillion officially. So we're just a little over 1 trillion at $1.024 trillion. So let's see here. What else do I want to hear? Total credit card debt still sitting at $1.3 trillion. That equates to per cardholder. That equates to $8,251 on average per cardholder. So there are some of our big numbers. Now let's take a look at mortgage rates real quick. What did mortgage rates do this week? So according to rates from Zillow Lender Marketplace, the current 30-year fixed rate is 6.25%, up 7 basis points from yesterday. Meanwhile, the 15-year fixed rate is up 9 basis points to 5.66%. So we did see a little bit of a jump here in mortgage rates from last week to this week. And let's take a look here at today's rates, and this is as of today. So 30-year fixed rate at 6.25%, the 15-year fixed rate at 5.66%. A 5/1 ARM is currently at 6.41%, and the 30-year VA mortgage at 5.71%. So again, it kind of gets back to the same thing I've been saying for the last 2-3 weeks. These rates they're not terrible, not catastrophic. We would certainly like these to be a little bit better. I liked where they were 2 months ago, where they were basically down at 6%, just a hair below 6%. That was kind of the sweet spot I was looking for, and that was really where I was hoping that rates were going to stay at for a while. Obviously, the whole conflict in Iran and everything has now bumped it up, but it hasn't been catastrophic though, right? It hasn't been terrible. I mean, obviously, going from 6% to 6.25, not the end of the world. I mean, people aren't going to love it. It's not necessarily going to make getting mortgages and things easier, but it's not devastating. It's not like the rate shot back up to 7% or went back up over 7%. So again, still hanging out here at a good bandwidth. And obviously, for all the veterans out there, you can still get a 30-year VA mortgage at 5.71%. That's pretty good. That's not too bad. Okay, now on the refinance side of things. So these are for refinance rates. So the 30-year fixed is at 6.18%. 15-year fixed is at 5.66. 5/1 ARM at 5.96%, and the 30-year VA at 5.75%. So again, on the refinancing rates, again, not too bad, still hanging into a decent range. So not the worst thing in the world. So okay, let's say, I think I got to make this a little bit smaller. Okay, so let's take a look at things. Stock market did pretty good this week. Up again. Nothing too bad. We're Dow Jones Industrial still hanging in there at 49,609. S&P 500 and Nasdaq are up at basically record highs. So again, not doing too bad there. Now let's take a look at interest rates here on the bond market. So the 10-year Treasury back up to 4.359%. So again, still kind of hanging in that bandwidth of that 4.3 to 4.4%. Again, still just like with the mortgage rates, a little bit higher than I'd like to see. I'd really like to get this down back to 4% or a little bit below 4%. Again, kind of where it was 2 months ago. But it's ratcheted back up here a little bit. The 2-year note is sitting at 3.895. And then, like I've pointed out here for the last month or so, these short-term bills, the 1 year, 6 month, 3 month, and the 1 month, they are all hanging in this insanely tight bandwidth of right here at 3.655 and 3.732. So it's a really tight bandwidth here. Just 5 basis points, 8 basis points spread between the 1, the 3, the 6, and the 1 year rate. So again, just really interesting to me that those continue to hang in such a very tight bandwidth. So we'll continue to keep an eye on that. But that's what I said. So there we are with the interest rates. Again, nothing too crazy, nothing too catastrophic, but a little bit high, just a little bit higher than what we would like. We'd like to hopefully get these things come back down, and we shall see here. Now, I'm gonna show you guys a bunch of Twitter posts here. This was actually kind of funny. I thought this was pretty funny. Jeremy Powell, too late to disaster for America. I just thought this was funny. Him being dropped into the trash can. Sorry, it's my juvenile sense of humor there. Okay, I'm going to run through a couple of things here real quick because this is going to kind of set the stage for some of the things that we're going to talk about here over the next probably 30 or 40 minutes. So, obviously, big news of the week here. You know, Ken Griffin, he was doing this interview here at the global conference. They were asking him about New York City and Mamdani and everything that was going on there, and basically said, well, you know, what the mayor of New York has made clear to us is that we need to double down on Miami. So again, not that is not good news for New York City. When with Ken Griffin's basically saying, you know, I'm out, I'm getting out of here, I'm going, I'm going down to Miami. Yeah, he's again, this it's not good because obviously Ken Griffin has a lot of very wealthy billionaire friends who they're all going to be talking and they're all going to be saying, yeah, we're taking our talents to South Beach, as it were. So, all right, let's see here. You know what? I might have to go back for a second here. All right. Now, EJ Antoni, who's an economist I've talked about a few times before, he was going nuts the last 2 days. He was he was throwing up a whole bunch of stuff on here that was pretty crazy. Right, look at this right here for a second. Check out. He puts check out this meme coin. Oh wait, these are the realized losses at the Fed, somehow labeled a deferred asset, representing a direct cost to the Treasury and therefore taxpayers. So look at this. I just want you to absorb this chart here for a second. And I want you to think about this. So what is this? What do you think this is? Well, this is losses at the Federal Reserve. This is losses at the Fed over the last couple of years here since 2020, basically the end of end of 24 or 23. This is basically 3 straight years of a major. This is almost to the negative of $240 billion. And now again, to be fair, there is a technicality here where the Fed, um, it's not like a direct loss, like he said, that this gets labeled as a deferred asset. So what happens is that basically that when the day comes when the Fed starts making profits again, they will whittle away at this loss. But you could see here how big of a loss this is. The Fed would have to generate profits, massive profits of tens of billions of dollars for years in order to wipe away these losses. I mean, yeah, I mean, you might be looking at 10 years. And that's if the Fed, gets back to positive territory and starts making money again. You could be looking at 10 years before they're able to overcome these losses. And like you said, and in the meantime, this is the taxpayer. This is the taxpayer who's left on the hook, dealing with this. I mean, it's pretty crazy. Um, all right, I'm looking for some other things here. So bank reserves are back up over 3 trillion as intended by the Fed's QE light, or asset management, or whatever you want to call it, nomenclature aside. It'll be difficult but not impossible for Warsh to bring reserves back down. They're still up 88% from pre-pandemic levels. So yeah, I mean, pretty amazing there. You look at January 2020 and you just look at, and again, these are the bank reserves, and you just see how massively high they are. Let's see, what else do we got here? Government payrolls in April were down 249,000 since January of 2025. So good progress. So that was in government, basically the reduction in government jobs. Let me see what else we got here. Labor force participation headed in the wrong direction last month, with LFPR falling to 61.8, the lowest since October of 21. It's never recovered since the COVID collapse. So yeah, so very interesting there. So now again, I would put a little caveat in there. Like when you say, so labor force participation rate at 61.8%, is that, again, it's one of those numbers. It's like, is that really catastrophic? Like, no, not necessarily. But at its highest, I think I want to say, if you go back the last maybe 20, 25 years, I think the highest in labor force participation rate probably got up to about 67, 68%, something like that. So now if it were to fall, much below this, then yeah, that would get pretty bad. You start to get below 60%. that's pretty bad. That I mean, you're something is really wrong in the economy at that point. But I think I would say in the average bandwidth, your labor force participation rate is probably in there at 62 to 64%, somewhere in that bandwidth, that range. So again, it's not the best number in the world. The trend is certainly not going in the right way, but it could be better. I'll just put it that way. It certainly could be a lot better. Now, obviously, we all saw this story this week. I'm not even going to give this oxygen. I'm not going to. I'm not. Everybody knows the story. Everybody saw this online. It's the whole story is absurd, and I'm not going to touch that one. I made myself a promise this week that I was not going to touch that. All right, what else you got here? Okay. April jobs report shows good earnings growth with average weekly earnings up 0.45% month to month, but that likely only matched inflation for the month, meaning that the average American could buy with his or her weekly paycheck didn't budge. So like basically whatever it is that you could buy, you didn't gain any ground here, basically. All right, so let's look at a couple of things here real quick. So a couple of job numbers here this week. So jobless claims stayed near historic lows ahead of April jobs report. So job creation, for the most part, has been concentrated in healthcare, with more than 400,000 new positions since March of 2025. So the number of Americans filing applications for unemployment benefits remained historically low last week ahead of the April jobs report. For the week ending May 2nd, initial jobless claims rose by 10,000 from the previous week to a seasonally adjusted 200,000. According to new Department of Labor data released on May 7th, economists had penciled in a reading of 205,000. Last week's figure, the lowest since 1969, was revised a tad higher to 190,000. The 4-week average, which strips out week-to-week volatility, declined to 203,250. So despite a wave of layoff announcements by major tech and non-tech firms this year amid the adoption of artificial intelligence, jobless claims continue to hover around historic lows. Others might be having an easier time finding employment opportunities. Continuing jobless claims, a measure of individuals currently receiving unemployment benefits, dipped to a lower than expected 1.766 million. The previous week's number was adjusted lower to 1.776 million. Economists use this statistic to gauge, in part, the health of the U.S. labor market and the difficulty out of work Americans may face in finding jobs. Additionally, it could signal that people are exhausting their benefits, since many state limits eligibility to 26 weeks. So over the past year, employment conditions have been described as low fire, low hire, while the latest data confirm the first half of that narrative. The April jobs report could determine whether the second half needs to adjust. So, okay, and then we go to this. Private payrolls rose by 109,000 in April, topping expectations according to ADP. So, private companies added 109,000 jobs for the month, a step up from the 61,000 created in March, and better than the Dow Jones consensus estimate for 48,000 ADP reported on Wednesday. Education and health services again dominated, adding 61,000 jobs. Trade, transportation, and utilities gained 25,000. Construction, another consistent leader in recent months, rose by 10,000. Though the headline number was better than expected, it's broadly consistent with what Fed policymakers and economists have described as a low hire, low fire environment. Then we go over to this. So the actual jobs report that we got here on Friday. So the U.S. economy adds 115,000 jobs in April, beating market estimates. So the unemployment rate also held steady at 4.3%. So the U.S. labor market could be showing signs of heating up after the economy topped economists' expectations. April payrolls rose by 115,000 from the previous month's upwardly revised 185,000. So not only did we get a decent jobs report this month, last month's report was revised upward to 185,000. So that's great news. So So, according to the new Bureau of Labor Statistics data released on May 8th, the consensus forecast indicated a gain of only 62,000 jobs. So, the unemployment rate remained unchanged at 4.3%, in line with market estimates. For the past year, unemployment conditions have been typically described as low fire, low hire. New data could suggest that while the economy is witnessing a low number of layoffs, hiring could be gaining momentum. Employment gains were broad based last month, led by healthcare with 37,000, transportation and warehousing at 30,000, and retail at 22,000. Federal government payrolls continue their downward trend, erasing another 9,000 jobs. Since reaching a peak in October of 2024, federal government employment is down by 348,000 jobs, or 11.5%, the Bureau said in May 8th report. Federal employees on furlough during the partial government shutdown were counted as employed in the establishment survey because they worked or received or will receive pay for the pay period that included the 12th of the month. Payrolls in the information sector lost 13,000 jobs as employment in motion picture and sound recording and computing, in data processing, infrastructure providers, and web hosting continued to decline. Manufacturing also shed 2,000 positions, and then wages fell short of economists' projections. So, however, U.S. manufacturing activity does hold steady despite surging costs. So the war in Iran and tariffs remain top of mind for U.S. manufacturers. So the U.S. manufacturing activity held steady in April despite the war in Iran driving up factory costs. New industry data released on May 1st show April's Purchasing Managers Index, a monthly survey of firms indicating the sector's prevailing economic direction, was unchanged at 52.7%, according to the Institute for Supply Management. Although it fell short of the market estimate of 53, it was the highest level since August of 2022. So new orders accelerated, production expanded, and supplier deliveries lengthened. Employment levels declined at the fastest rate in 4 months. Prices advanced last month, climbing at the sharpest pace in more than 4 years, driven by rising oil and diesel costs tied to the 9-week-old Iranian conflict. So the Iranian war remains top of mind for respondents, but tariffs were also a second concern for manufacturing companies, said Susan Spence, chair of the organization's Business Survey Committee. So again here, U.S. manufacturing, despite tariffs, despite the conflict in Iran, still hanging in there pretty good. Did have a little bit of dip, losing 2,000 jobs last month, but overall not the worst thing in the world. Like, still kind of hanging in there. Now we get to the booming oil shipments lift U.S. exports to a record high in March. So amid higher demand for soybeans, exports of food, feed, and beverages increased by $1.1 billion. So U.S. exports climbed to a record high, driven by surging shipments of crude oil and other petroleum products during the first month of the war in Iran. New government data released on May 5th. The U.S. international trade deficit in goods and services reached $60.3 billion in March, up 4.4% from the previous month, according to the Bureau of Economic Analysis. February's trade gap was adjusted a bit higher to $57.8 billion. This came in slightly lower than the consensus forecast of $60.9 billion. But exports jumped $6.2 billion, or 2%, to an all-time high of $320.9 billion. The March gain was fueled almost entirely by shipments of goods, particularly industrial supplies and materials, due to higher war-driven energy prices. The main contributors were crude oil at $2.8 billion, petroleum products at $1.7 billion, and fuel oil at $1.6 billion. Amid higher demand for soybeans, exports of food, feed, and beverages increased by $1.1 billion. Conversely, consumer good exports fell by $1.6 billion. So again, so some good news in all of this chaos, if you will. Now, here is the big problem at the moment. Gas prices drag U.S. consumer sentiment to record low, according to survey. So resolving supply disruptions and falling energy prices might be the only factors to boost sentiment. So Americans have a downbeat view of the U.S. economy driven by higher gasoline prices, according to the University of Michigan's widely watched consumer survey. The preliminary May Consumer Sentiment Index declined to a record low of 48.2 compared to the trough reached in June of 2022 when inflation peaked at above 9%, the university said on May 8th. Now, this month's lower than expected reading was fueled by a 9% drop in current conditions and little change to expectations. Consumers cited concerns surrounding higher prices, personal finances, and buying conditions for major purchases. Real, that means inflation adjusted income expectations, extended the decline from March. About one third of consumers spontaneously mentioned gasoline prices, and about 30% mentioned tariffs. So, again, I mean, you're definitely seeing this major impact from gasoline price. I know I felt it. I fueled up the gas tank a few times this week, and man, it was very expensive. I mean, the most expensive it's been in probably the last, easily the last 3 or 4 years, since obviously the whole fiasco with the Biden administration, when gas prices literally got up to a little over $5 a gallon. We're not far from that right now. I think I paid about $4.70, almost. Maybe it was like $4.69 a gallon here in Pennsylvania. So I mean, this is gotten absurd, and something needs to the whole Iran conflict needs to be resolved right quick, because this is not going to go over well with anybody, and consumer sentiment is going to continue to go into the toilet, because we just, again, it's only been in the last week or so that we saw gas prices jump into the $4+ category. So it's not necessarily going to take effect like overnight. But if the gas prices continue to stay at this level and they drag on like this for just the next month, this is not going to be good. Not going to be good. This is going to begin to reverberate through the entire U.S. economy. Because obviously diesel gasoline prices gone through the roof. That, again, this is not good. And then we go to global oil reserves plunge at a record pace amid Iran war. So S&P Global Energy reported that oil reserves fell at the fastest rate ever outside of COVID-19 pandemic. So global oil reserves plunged at a record rate in April as the ongoing Iran war and ensuing closure of the Strait of Hormuz strained supplies, according to estimates by S&P Global Energy reported on May 6th. Stockpiles of crude fell by nearly 200 million barrels, or 6.6 million barrels per day, even as higher prices triggered a collapse in demand of about 5 million barrels per day, marking the sharpest ever fall outside of the COVID-19 pandemic, according to estimates by the commodities giant that were published by Hellenic Shipping News. Jim Burkhardt, vice president and global head of crude oil research at S&P Global Energy, said that while there have been significant impacts to date, the oil market has remained somewhat cushioned from the full impact of the loss of 15 million barrels per day in supply. That the cumulative supply loss is now approaching 1 billion barrels a day is a staggering figure that inventories cannot cover indefinitely. He added, saying that an inevitable market reckoning is coming. So, like I said, this needs to get fixed right quick, or we're going to start to see massive problems. And one of the things I talked about last week when I was covering a little bit of the Iran conflict and kind of the ramifications it was having on fertilizer, aluminum, helium, all these different type of things. One of the things I covered was the fact that what Iran has done up to this point, like they're about to have a lot of tremendous infrastructure problems with their oil production. And the problem is that, like, in other words, they took basically all the oil they had, they kind of stored it or put it in containers, but now that's all filled. Like all their containers, reserves, anything they could back up has been backed up, and now it's all tapped out. And now all the oil that's getting produced is not coming out; it's just sitting there. Basically, their machines are going to get backed up, and then that's going to cause major damage to the machines, which of course then will take a lot longer to get back up. And once this thing ends, take that much longer to get back up and running, get the production back up to where it needs to be. So I mean, you could literally have again, there could be ramifications here that could end up playing out for the next couple years, depending on how this goes. And that's why I said like this needs to get ended real quick. Otherwise, you're going to have massive declines in the global oil reserves. Just dropping by billions of barrels of oil a day, like, and that is going to have all kinds of massive ramifications throughout the global economy. So just not good. And then we have this here for a second. So Whirlpool says Iran war causing recession level industry decline. The shares are down 12%. Now, Whirlpool is one of those things to keep an eye on. Like I always say, you have these kind of non-direct barometers, if you will, of the health of the economy. Like I always like looking at, Home Depot and Lowe's. How are their results doing? Home Depot and Lowe's, how they're doing will tell you a lot about the real estate market, right? Like if people are out there, if they're improving houses, if they're doing renovation projects, if you got investors out there doing a lot of flip projects and things like that, that kind of activity will show in Lowe's and Home Depot's earnings, because they'll report a lot of that information. They'll say, oh yeah, our contractors are out buying tons of stuff. People are working on their houses. They're buying tons of product and materials. But if you don't see that going on, you basically know that, okay, real estate's probably not doing that hot at the moment. Same thing with like fast food. Like I always say, like, keep an eye on fast food, like the sales in fast food. Like if you see McDonald's is struggling, people aren't buying food at McDonald's, like that's a great indicator. When you start hearing people, like one of the things I knew that Kamala Harris was not going to win the election was because over the last year leading up to the election, fast food prices had gone way up. And basically, and who eats the fast food? A lot of poor people live basically on fast food, so as the price goes up, that's a whole lot of people there that aren't going to be voting for you because they're not going to be happy with the prices of these things. So, and that goes both ways too. It's not just to say that that's like a Republican or Democrat thing. That fence swings both ways. Regardless of what party's in power, if you have affordability issues, the party that's in power is getting blamed for it. So that's why I said, like, for Republicans out there, if they don't do something to address the affordability issue in a big way, if they don't bring these gas prices back down right quick, yeah, their odds of winning, re-election in November are going to go right down the toilet. That's just because people at the end of the day, as much as you want to talk about politics or whatever, the reality is most people out there will vote with their wallet. Okay, if they think they're getting a bad deal, okay, it's time to try somebody. You didn't work out, now we're going to try somebody else, and they'll keep going until they finally hopefully find somebody who will address and work out the affordability issue. But again, having Whirlpool here say that that Iran, this whole conflict is about to kick off a recessionary level industry decline. Again, it's something to pay attention to. It just is. So, and then it says in here, war in Iran resulted in recession level industry decline in the U.S. as consumer confidence collapsed in late February and March. Whirlpool said the comments underscore how sharply higher fuel prices and collapsing consumer confidence are beginning to weigh on big ticket purchases. So yeah, so again, just something to keep an eye on here. Whirlpool basically just saying like, yeah, like all of our sales are just collapsed. Our sales are way down, and we haven't seen anything like this in a long, long time. So, so like I said, so we'll keep an eye on it. So now, so again, so just to recap on that, so we got a lot of positive news this week as far as economic indicators go. So again, just going back here, so just real quick to recap. So jobless claims stayed near historic lows. What is this? I don't know what happened. I got an ad or something here. And then I lost the article. But basically, the jobs report was really good. U.S. economy added 115,000 jobs in April, beating estimates. So that was great. U.S. manufacturing activity held steady. We have this booming oil shipments lift U.S. exports to record highs. So again, even though we have this affordability issue, we have the issue with the price of oil. Things, like I said, there are still some decent things going on right now. It's not all horrible or bad news. One thing I did want to check here on the commodity front. So again, interestingly enough, crude oil did drop back down under $100, back down to $94.68. Brent, however, is still hanging out literally right at $100. So again, we really like to see those numbers drop back below, well below $100. I mean, you'd really like to see that, drop back down to $70, $60. I don't know. Again, I don't know how quickly that can happen. I mean, even like I said, even if the Iran conflict ends and they find some kind of peaceful resolution, it could still take time for all of this to, work itself out. But like I said, just wanted to note that real quick. So all right, now we're going to switch gears for a second because I wanted to go back to the Fed here for a minute. So we did have some updates. Obviously, I talked a lot last week on the FOMC. They made their interest rate decision last week, but then we also heard Kevin Warsh made it through the Senate Banking Committee, and he is now going to the full Senate for a confirmation vote. But then we also talked about Jeremy Powell basically announcing he was not leaving. And basically, he said that he had to stay on, supposedly, because of this ongoing investigation, right? Well, okay, fair enough. But now we got this news this week. So Judge Jeanine Pirro basically changed his course in Fed investigation. But the move is unlikely to satisfy Powell. Of course it will, because that's not really what he's staying for. And I talked about that last week. I think he's staying just to be a thorn in Trump's butt. Like, that's really what he's doing. It really has, I really think it has nothing to do with this investigation at all. But anyway, U.S. Attorney for Washington, D.C., Jeanine Pirro, on Monday filed a motion to vacate a judge's ruling against her in proceedings involving her investigation of Fed Chair Jerome Powell. In doing so, Pirro abandoned her plan to appeal the judge's ruling, which would have seen a higher court weigh in. Pirro's move isn't likely to give Powell the certainty he wants to step down from the Fed's Board of Governors. Of course it won't, because the reality here, and I could promise you this, so now this investigation, if you will, has moved into the Office of the Inspector General for, wait for it, the Federal Reserve. So the Fed is running their own investigation into itself. Okay. So, of course, what are they going to find? Nothing. They will find nothing. Nothing will come back. And Powell knows this, like he knows this. So as soon as this investigation is now we've moved a step closer. So basically, Judge Jeanine basically said, she's not going to pursue it. She's put in a motion to vacate. So she's basically the whole thing is being dropped. And now, like I said, the Office of the Inspector General is taking a look at it. So even when the Office of the Inspector General comes back and says, we didn't find any wrongdoing, it's all fine, whatever, I guarantee you Powell will come out with just another BS excuse as to why he needs to stay on. He needs to hang around. And like I said, I believe it really has nothing to do. Him staying has nothing to do with this investigation. It's all about him just being an obstructionist, just causing problems. Like I said, being a thorn in Trump's butt, like that. That's all that this is really about at the end of the day. And now we get some other news here. So Warsh's take on Fed independence is met with confusion and some concern. So Kevin Warsh, President Donald Trump's nominee to lead the Federal Reserve, has described the Fed's independence as being at its peak in certain areas, but much lower elsewhere. Several former Fed officials told CNBC that Warsh's view is entirely clear, but taken to extremes, it could mean the Fed would lose control of vital tools such as its balance sheet. A plan by Warsh to strike a deal between the Fed and the U.S. Treasury is also raising questions. So most people don't know and don't have much reason to care what a currency swap line is, except that the financial instrument could soon help markets understand what Federal Reserve Chair nominee Kevin Warsh's unique ideas about Fed independence really mean. Warsh has said categorically the Fed should be strictly independent in the making of monetary policy, but he adds that he's willing to work with Congress and the Trump administration on non-monetary matters. In answers to senators' questions following his April 21st confirmation hearing, he elaborated, Fed officials are not entitled to the same specific deference in areas affecting international finance, among other matters. Warsh has also talked often about a new Fed/Treasury accord that he suggested could govern the Fed's balance sheet, though in ways he has yet to detail. To 6 former Fed officials, for this article, whose comments were unclear or confusing at best. When it comes to Fed independence, they found his analysis worrisome at worst. The outcomes could be benign, tinkering around the edges of existing conventions, or more concerning limitations to the Fed's ability to use its balance sheet in a crisis. Because of the lack of clarity in Warsh's comments, none of the former officials who spoke with CNBC were ready yet to draw conclusions either way. So, yeah, I think this article is just a bunch of hogwash. I mean, to have these guys come out like, oh, we're so concerned and he's so confusing. No, actually, he hasn't been confusing in the least bit. He just said that all he has said is that he wants to rein the Fed in certain areas, and he wants to try to work with the Treasury a little bit more. Is that confusing? I must have missed something. Is that confusing? And then and imagine something for a minute. So I want you just to imagine something. So Donald Trump and his administration has been able to do a lot of good things so far in his second term. They were able to start off doing a lot of very good things. However, he's had to do it with basically, one hand tied behind his back, because the Fed hasn't really worked with him. He's got the Treasury doing a lot of good things, but Congress is effectively worthless. They've done nothing in a year and a half. What have they done? They passed the big beautiful bill with a bunch of watered down tax credits, and they saved his original tax credits from 2017, and they gave us a bunch of watered down other tax credits that are helping some people, making some impact, but are not going to be earth shattering change at the end of the day. Yeah, not to like poo poo it or anything like that, but I'm just saying that Congress they haven't done anything. What have they done here? What have they done in the last 9 months? It's just been shut down here, shut down there. Oh, we can't do anything. I got to go on vacation here, vacation there, vacation everywhere. These guys we're lucky if these guys work 10 days out of the month. I mean, it's crazy. So just imagine, if you will, for a second, that you had the Fed, the Treasury, Congress. Imagine if they were all working together as one team with the administration to get things done. Wouldn't that be amazing? Wouldn't that be magical? Can you imagine what any administration would get done if everybody was working together on the same team for once and had everything done? So heaven forbid that Kevin Warsh should come in here and basically say that, hey, you know what? One of the things I'm going to do, because it would be good for the economy and good for everything, is I'm going to work with the Treasury, and we're going to come up with this new accord, and we're going to work on ways to fix some of the damage with the economy and make things a little bit better. Oh Lord, help me! I'm going to faint. I mean, what is confusing about this? Like, I'm still trying to figure this out. Like, what is confusing about this? So again, we gotta. I just this article, I just can't with this. Like, it's like, oh, it's so confusing. He's not being clear about Fed independence. Yeah, okay, yeah, whatever. We'll see. Okay, and then let's go. I want to talk actually interest rates from across the pond here for a few minutes. So the ECB is closer to a rate rise than BOE. In other words, the European Central Bank is closer to a rate rise than the Bank of England as energy prices stay high. So the ECB's president revealed the governing council had discussed raising the key rate, but that doesn't mean an increase in June is certain. Now, to just to be fair, for a little bit of context here for everybody, the ECB and the Bank of England, they lowered rates a lot more aggressively and a lot faster than our central bank, the Federal Reserve, has done. So they're way lower than we are right now, and they got lower a lot faster. So for them to kind of come out here and say, "Oh, okay, we might do a raise, we might go 25 basis points, or we might do a couple little raises here in a row." Again, not really the end of the world compared to us, because they would basically just be catching back up to kind of like break even with us, if you will. So just keep that in mind as a little bit of context there. So Europe's leading central banks have moved in lockstep since the outbreak of war in the Middle East, but they may soon part ways. As they did in March, the European Central Bank and the Bank of England Thursday left their key interest rates unchanged and warned that borrowing costs may have to rise to contain the jump in inflation triggered by the conflict. But the ECB seems more likely to pull the trigger at its next meeting than does the BOE. In her news conference following the announcement of the decision, President Christine Lagarde revealed that the governing council had discussed the option of raising the key rate in some detail, preparing the way for a move when it next meets. While Lagarde stressed that the decision to keep rates on hold Thursday had been taken unanimously, the mention of a rate hike debate clearly suggests that the ECB has moved closer to a rate hike at the June meeting. A June rate hike is by no means certain, however. Peace could yet break out, and the reopening of the Strait of Hormuz could lead to a sharp fall in energy prices, and with it, changed expectations for inflation. But if that doesn't happen, borrowing costs seem set to rise in the Eurozone. By contrast, the Bank of England sought to play down the inevitability of a rate rise despite market expectations of two moves higher this year. It is not the case that we are giving some clandestine message that interest rates are going to go up, said Governor Andrew Bailey as he told reporters. The difference in signals reflects the respective economic and policy positions when the war broke out. So, while the ECB had lowered its key rate to a level that neither restrains nor stimulates activity, the BOE's key rate was still at a level that holds back growth. ECB policymakers expected to leave the key rate at 2% for 2026, while their counterparts on the BOE's Monetary Policy Committee expected to lower borrowing costs by half a percentage point as inflation finally fell back to target. What that means is that leaving policy unchanged has more of an effect on activity and inflation in the UK than it does in the Eurozone. So, and then let's look at this for a second. So, central banks risk a recession by raising rates to tackle Iran oil shock, strategist warns. So, global central banks are grappling with the oil price shock caused by the war in the Middle East. Investors now anticipate rate setters to increase borrowing costs in a bid to combat runaway inflation. But the supply side nature of oil shock means central banks would need to push rates to seriously high and recession inducing levels, according to one strategist. So, central banks risk a global recession by raising interest rates in a bid to contain soaring energy costs. Julian Howard, chief multi-asset investment strategist at GAM Investments, warned that rate setters are now on the verge of policy mistake territory as expectations of rate rises grow. Howard said that the traditional response to raising energy costs, ramping up borrowing costs, is an error given the supply side nature of the energy price shock. The kind of interest rates that are needed to actually stop people filling up their cars, to stop people flying, would be seriously high, very, very high, and recession inducing, Howard said. And again, the European Central Bank held rates steady last week. Despite Eurozone inflation coming in at 3% in April, the Bank of England also left rates unchanged as the UK grapples with higher oil prices. But that being said, investors are now pricing a June ECB rate hike, while Bank of America Governor Andrew Bailey told CNBC that a protracted energy price shock could force the bank's hand on borrowing costs. So, the Reserve Bank of Australia has already moved, increasing rates by 25 basis points to 4.35% on Tuesday after higher fuel prices pushed headline inflation in the country to 4.6% in March from 3.7% the previous month. So other global monetary authorities could also follow suit. So so we are going to have to definitely keep a very close eye on this and see what a lot of these central banks end up doing around the world, because this could have massive implications on the global economy and how a lot of stuff plays out here. So again, what is the takeaway from this? Well, the takeaway from this is that if the issue with the Strait of Hormuz, if that doesn't get resolved anytime soon, that means that central banks are going to start raising interest rates to combat inflation, which will increase borrowing costs, which basically will start to slow everything way down. And that will be their way of trying to combat the inflation. but that will cause a myriad of other issues. Like I said, this will be recession inducing for sure. So we have to keep an eye on how all this plays out here. But again, not a good thing at the moment here. So all right, now talked about this here at the beginning. So Ken Griffin says that New York doesn't welcome success under Mamdani. Billionaire suggests expansion will focus on Miami after mayor criticized the 238 million dollar home. So, billionaire Ken Griffin on Tuesday amplified his criticism of New York City Mayor Zoran Mamdani and suggested his investing firm Citadel would double down on Miami's being the place for growth instead of Manhattan. Mamdani is making it really clear New York doesn't welcome success. Griffin, the founder and chief executive officer of Citadel, said at the Milken Institute Global Conference in Beverly Hills, California. The mayor recently appeared in a video in front of a property Griffin purchased at 220 Central Park South in 2019 for roughly $238 million, a deal that set a record for the highest priced home ever sold in the U.S. We've secured a Pier-a-Terre tax, Mamdani said in the video posted April 15th. This is an annual fee on luxury properties worth more than $5 million whose owners don't live full-time in the city. Like for this penthouse, which hedge fund CEO Ken Griffin bought for $238 million. Griffin called the video creepy and weird. It was a little creepy and weird. He alluded to alleged security risks, saying the video was frightening. And he mentioned that the CEO of United Health was fatally shot not far away. Anything that creates like an agitation in the extremist on other side of the aisle is a frightening dynamic, he said, before condemning political violence and bringing up the recent assassination attempt on President Trump and other administration officials at the media dinner in Washington, D.C. I've had my differences with President Trump over the years. I've also had a lot of wins with him, but the idea that he has survived 3 assassination attempts is just incomprehensible. Joe Cavello, the mayor's press secretary, responded with a statement saying Mamdani wants all New Yorkers to succeed. Yeah, okay. Look, I will be the first to say I am not the biggest fan of Ken Griffin because I think Citadel has done a lot of things to shaft your everyday investors out there. I think that they, again, hey, look, they've been massively successful, good on them. I think, look, they're they started out many years ago, high frequency trading firm. Signed a deal with TD Ameritrade to basically get access to process all their trading so that their traders could all front run all the retail traders that were using TD Ameritrade. But for payment order flow, they don't, of course, see it that way. They see it as, well, we're market makers and we're really helping the investors by shafting them. That's how we make this thing work for everybody. Yeah, okay, all right. So again, I'm no big lover of Ken Griffin, but what the Democrats are doing in New York and a lot of these other blue states right now is just it's just they're going about this just in a horrible fashion, and is not working out for them. And why do I say that? Oh, well, let's take a look at this article here. Philadelphia loses 1.1 billion in income as residents shift within the region. Now, these are a lot of people shifting within the region, but ultimately this is a lot of people trying to get out of Philadelphia, because Philadelphia, to a much lesser degree, is still doing a lot of the same. Like, again, all these major cities, they're all in like the doom loop, if you will. Like they all, it's just like, oh, it just their answer to everything is just perpetually increase the taxes, increase the regulation. You never ever hear them come out saying, oh, we're cutting red tape. We're going to reduce your taxes. We're going to reduce the tax over here. And what's wild is they'll all sit at a table eventually at some point, and they'll all sit around and they'll go, huh? Like, again, I'm going to use PA as an example. PA will sit around and they'll go, huh? All right, let's see what is Ohio doing with taxes? What's West Virginia? What's Virginia doing? What is New Jersey doing? What's New York doing? They look around at all the neighbors, and they sit there and they go, man, we could do a lot better if our tax base our tax rates in the region were a little bit more attractive. We could get a lot more business in here, and then they all say that, oh yeah, that's what we need to do. We need to cut the taxes, but then it never happens, and then invariably they end up going back and raising the taxes. Which is just, again, it's just wild. So let's see here. So Philadelphia lost 5,300 tax filers and 1.1 billion in adjusted gross income. The 9-county Philadelphia region gained, however, nearly 19,000 tax filers who brought 1.3 billion in adjusted gross income. Metro New York experienced a 50 billion decline in adjusted gross income due to net out migration. Let me say that again. Metro New York experienced a $50 billion decline in adjusted gross income due to net out migration. Like, there it is. So you have a bunch of people from New York moving down into the Philadelphia region because they see this area as more affordable, lower cost of living, all that kind of stuff, but you still have this outflow of a lot of people out of the Philadelphia region taking $1.1 billion with them. So again, it's just you kind of look at this, and then we get into, these are the hiring hotspots where college grads are landing good jobs. And I just want to share this, everybody, because I think this is, this goes hand in hand with the other things that we're talking about. So, like, look at this. So, best prospects for many 20-somethings are in the fast-growing southern cities, a new analysis finds. So, the top 5 metro areas by percentile for 20-somethings with college degrees. Look at what was number 1. Birmingham, Alabama is number 1 on this list. I mean, how wild is that? That's the overall winner here, followed by Tampa, Florida. San Jose, California does make the list, but then you get Columbus, Ohio, and you get Raleigh, North Carolina. I mean, it's again, not really shocking when you see what's going on. I'm actually, the thing that's shocking to me is that San Jose is on this list. But a string of cities across America's Sun Belt are emerging as graduate hiring hotspots in an otherwise challenging job market for young professionals, and exclusive analysis shows. Birmingham, Alabama tops the list of places where newly minted graduates are landing jobs with a college-level career track, followed by Tampa, Florida, according to a new study by payroll processor ADP. In fact, 6 of the list's top 10, including Raleigh, North Carolina, Tulsa, Oklahoma, Nashville, Tennessee, and Charlotte, North Carolina, are all in the South. But more importantly, what I talked about last week, they are in the 11-state, what's called the Boom Belt. They are in the 11-state Boom Belt. Other pockets of the country also punched above their weight as early career launch pads for their mix of 20-something hiring, pay, and affordability. Columbus, Ohio, and California's San Jose area unexpectedly got top scores this year, evidence that even places with so-so earning potential or higher cost of living can be prime locations for landing that first job post-graduation. Altogether, the ADP analysis, which measured 53 of the country's biggest metro areas, shows that what looks like a nascent recovery in graduate hiring is happening unevenly. Recent data shows companies are boosting entry-level hiring this spring after holding back for several seasons, but their appetite hinges a lot on the kind of role, sector, and location. But again here, so let's look at some of the big ones here. Again, you've got Orlando, you've got Richmond, Virginia, you got Houston, Dallas, Louisville, Nashville, Austin, Texas. So again, a lot, Baltimore's on here. But and again, it's just, so this is in the South, and then the places in the West, Denver, San Francisco, Fresno, San Jose, in the Northeast, Mid-Atlantic, New York, Providence, Rhode Island, Pittsburgh. In the Midwest, Columbus, Ohio, Indianapolis, Chicago, Milwaukee. But I would say that, again, you're seeing this movement of a lot of big companies down into these southern states. And so it's no surprise that this is where a lot of young college graduates are finding success, finding jobs, is in these states that a lot of these companies are moving to. Again, that's why I said this stuff all ties together. So again, my whole point here is that and this is why I have covered this trend of, I've done what, 3, 4 episodes now on the whole trend of, Democrat cities and Democrat blue states just losing people because of their really bad policies, particularly around taxes, particularly around regulation. And what a lot of times what they want to do with the money is not, it's one thing to get the tax dollars, but it's all, the other side of the coin is how are you spending said tax dollars, and they spend it in horrible ways, horrible ways. And so it's like a double whammy. It's like, not only are they increasing your tax money, taking more of your tax dollars, but then they just waste it on the other end. So it's a double whammy of just more tax, more waste, more tax, more waste. So that trend has to stop, because again, what eventually is going to happen is, these southern states with all this boom, sooner or later they're going to have their fill. I mean, everybody in the U.S. can't move to 11 states. Like, it's not going to happen. So something has to give there with this trend sooner or later. But I do have a feeling that it's going to get a lot worse before it gets better. So, all right, now let's move to real estate here for just a couple minutes, and then I want to get to our economic indicators and my episodes that I put out this week, and some other bank news and things like that. So, high housing costs are pushing foreclosures to a 6-year high. So homes with foreclosure filings jumped 26% in the first quarter, partly reflecting rising property taxes and insurance premiums. So U.S. foreclosure filings hit a 6-year high in the first quarter. Fast rising home ownership costs, such as property tax and insurance bills, are a reason to blame. The number of U.S. properties with a foreclosure filing rose to almost 119,000 in the first quarter, according to property data provider ATOM. That marked a 26% jump from the same period a year earlier. That figure is also the highest since the first quarter of 2020, when pandemic-era mortgage relief measures and stimulus payments first led to a huge drop in foreclosures. The current foreclosure rate is a return to the pre-pandemic norm and not a sign of widespread borrower distress. Analysts say many homeowners have low mortgage rates and have benefited from home price appreciation in recent years. But the recent increase is an indication that more people are struggling, especially when rising costs for home ownership, property taxes, or homeowners association dues pushed up their monthly bills. These new causes of distress could be a warning sign of more pain to come. Some borrowers' student loan payments have also resumed, adding to their expenses. Delinquencies for credit card bills and car loans have also risen. Homeowners who bought their homes within the past few years might be even worse off because they bought at higher mortgage rates. In some areas, prices have slipped, leaving homeowners underwater. They also have fewer relief options than they did during the pandemic. So yes, so I want to go back to that for just a second. So, obviously we had this massive spike. So before we got hit with the interest rates in 2021, coming out of the pandemic, the purchasing, like, real estate just went nuts. All of, like, so many people wanted to get out of the cities and wanted to buy, just tons of properties. We also had the massive migration issue. It could have been 20, 30 million people coming into the country that just drove up, this massive spike in demand for housing, and that just drove housing prices through the roof. We had, and we all saw it in all parts of the country. I mean, somebody would put a house up for sale, and that house would sell within hours. That house was gone. They had multiple offers. People in some instances were paying $50,000 in cash over whatever the asking price. If the asking price was $500,000, they would pay 550, and they'd pay the 50,000 in cash out of their pocket, and then do the regular home purchase deal with the mortgage and everything else. But and a lot of those people, even there, because again, the inflation spiked through 2022, and it wasn't until 23 or 22 into 23 that the Federal Reserve started jacking up the interest rates. So during that period, people probably still got into a lot of these houses with very nice rates, maybe 5%, 5.5%, something like that. But if a house was worth prior to 2020, if a house was worth 300,000 and it doubled in price and went up to 600,000, so when you bought it, you were paying property taxes and insurance on a house that was 300,000. And again, this takes a little while for like I said, for the tax man and for the insurance companies to catch up. It takes a little while, but they've now caught up. And what happens? So what happens is you bought a house for 600,000, and I knew this was going to happen. I said, once these townships, boroughs, municipalities, like they come back and they're like, holy cow, we need to reassess all these houses. Like, that house that we had assessed 5 years ago at 300,000 just sold for 600,000. Yeah, we need to reassess that. And that's what's happening. You're seeing reassessments all over the place, and thus driving this, massive increases in people's property taxes. And then the insurance companies are also jacking up the rates on people all over the country. So again, but this dual thing, and now all of a sudden, I think a lot of people in a lot of areas, like they might be paying, 15,000 $15,000 a year for property taxes. I mean, so think about that. I mean, you're paying, if you're paying 12,000 plus a year in property taxes, you are paying $1,000 a month for nothing. You're paying $1,000 a month for nothing. That's just tax money going out the door every month, just for the privilege to sit your butt in that house. Okay, so think about that. Just if you're paying 12,000 or more, you're spending $1,000 a month just for the privilege of the government to allow you the privilege to sit there in your house. You have to think, yeah, like I said, you got to think about that. I think a lot of people maybe don't think about it in those terms, but that's what's happening. So now we got this, right? And now we've got this. A property tax rebellion is emerging in America. Public K through 12 school spending now exceeds $1 trillion annually, and citizens groups say that they have had enough. So this town, Middleburg Heights in Ohio, at a petition table inside a Cleveland area gun show on a drizzly Saturday afternoon, citizens talk of the American dream derailed. There's the elderly couple who paid off their mortgage decades ago, but can't afford the property taxes on their home. Their local government theoretically can seize the property and auction it off to someone else if the annual bills remain unpaid. Then there's the recent retiree who took a part-time job at Lowe's to pay property taxes on his rental property and avoid raising his tenants' rent. Add empty nesters who can't downsize to smaller houses because interest rates are too high. Farmers describing an impossible situation, and recent college graduates groaning about moving farther away from home to an affordable place. Showgoers, guns and ammo in hand, pause at Beth Blackmare's table on their way out and share with her those concerns. If 413,000 residents throughout the Buckeye State sign a petition before July 1st, a public vote to eliminate local property taxes will appear on the November ballot. If the signature count falls short, however, is collected, can be applied to the following year or however long it takes, says Blackmare, media coordinator and a main volunteer for the 3,000 plus member Citizens for Property Tax Reform group. We are really hurting in Ohio. People never thought they'd be in this situation. So Ohio isn't alone. 46 states and the District of Columbia already have limits on annual local property tax levy increases, and leaders in Florida and Texas are pursuing additional legislation to limit government flexibility and how it raises revenues, according to a September 2025 report from McKinsey and Company, a global management consulting firm whose clients include state and local governments. Schools already strapped for cash hang in the balance. School districts struggle with declining student enrollment, unfunded mandates, state and federal aid lost largely due to skyrocketing Medicare costs and spiking employee health insurance costs. Let the state find a way where 100% of the population pays for education. They give profit-making businesses a break, but not us. Now, and again, I don't want to get into this whole long, protracted, property tax debate. I think there will be a time and a place for that. I just want to show that, what's happening. So what you're seeing here are the long simmering ramifications of, just the endless increase in property taxes. And this is the problem. Like when you get like when you start going nuts, like building apartment buildings, what happens is you build the apartment buildings and then families move in. Now, is that apartment building, and then those families start going to your local schools, and those kids go to the local schools, and then having all those extra families, now it puts a burden on the school. Might be busting at the seams. They might have to go build new buildings. They might have to expand. They might have to do other stuff. And guess what? Now they have to raise taxes. Then it also puts pressure on services like the police force, ambulance association, the fire department, all this stuff, and now all of a sudden, all these, got to hire more police officers, need more firemen. Maybe we need another fire station. And, so then you got to collect more and more property tax. And who pays that? The property owners pay that. And like I said, it punishes, the retiree, that person who's owned their house for 40 years and they did all the right things. They put their kids through school. They paid for their kids. They paid their house off, and now they're trying to retire. And now they're potentially going to lose their house because they can't afford to pay the freaking property taxes on it. I mean, that's insane. The government might end up taking their house if they can't pay their property taxes. I mean, and this is the kind of stuff that's outrageous. And we have to find some kind of fix for this. This situation can't continue as it is. Like, we cannot just continue to put, the school districts around the country, the teachers unions. So the day's going to come where it's like you're going to hit the wall big time, and basically it's going to be like, yeah, no more money. And obviously, I'll just say this: I mean, when you look at the performance of schools around the country, it's pretty evident that money is not the problem. We've been throwing money at the school system, at the public school system, for decades and decades and decades, and we spend more money on education here in the U.S. than any other country in the entire world, and yet our performance among kids. I mean, you look at, pick any inner city you want. You could pick Baltimore, you could pick Washington D.C., Chicago, Philadelphia. You pick any single one. The statistics from the kids are horrific. So it's obviously not the money. The system itself is completely broken. And so this idea that the answer is to just simply keep taxing forever, and then and they always want to whine and cry about all this stuff about, oh, well, this is happening at a time when schools, they just, they've got, unfulfilled mandates, and they got all this, and they, and insurance costs are going up, and blah blah blah. Yeah, I just that's not the problem. The problem is a really horrible K through 12 public education system that has just failed so many millions of children around this country. And that's the problem. And they will never look at themselves. And so this issue is going to continue to fester. It's going to continue to build, and sooner or later, somehow, it's gonna find its way getting fixed. And my thought is that the voters are gonna fix it themselves. Okay, they're gonna basically tell the teachers unions, they're gonna tell the local governments to go pound sand, and they're gonna say, we're gonna fix this ourselves. Okay, we're gonna vote for this ourselves, and just, yeah, no more property taxes. Like, yeah, we're just gonna get rid of it. If you want to build somebody, just build the parents directly for their kids that they have in the school system. They pay for that, and there you go. Maybe that's the answer. I don't know, but maybe something to that effect. But anyway, all right. All right, I want to get into, I've got, like I said, I got a bunch of articles here. I want to get into this whole AI conversation, but before we do that, I want to switch gears here for just a minute, because I want to go, as I do every week, I want to give you guys the economic indicators coming up for this week. I want to give you guys a bunch of banking news, and I want to talk about what I want to talk about the 5 episodes that I put out this week. So, but first, let's kick off with the economic indicators. You guys can see them up there on the screen. So, for Monday, May 11th, we got existing home sales for April. We get the 3-year Treasury note auction for Tuesday, May 12th. We get the core consumer price index. We get the consumer price index for April. We get the world agricultural supply and demand estimates. We get the 10-year Treasury note auction, the federal budget balance for April. We get on Wednesday, May 13th, we get the core producer price index, the producer price index, the 30-year bond auction. On Thursday, May 14th, we get initial jobless claims, continuing jobless claims, core retail sales for April, export import price index. And then finally, on Friday, May 15th, we get the New York Empire State Manufacturing Index, industrial production for April, and the U.S. Baker Hughes total rig count. So very active week here. We got to get some inflation numbers. We're going to get some manufacturing numbers, some retail numbers, a little bit of job numbers. But I will tell you what, the bond auctions are, we're going to have to keep a very close eye on that. The 10-year Treasury note auction, the 3-year Treasury note auction, and the 30-year bond auction. Really want to keep an eye on that. Obviously, we saw the Fed stepping in to buy a lot of these treasuries at the last bond auction. So definitely want to see if that trend continues, so to speak. So, but we shall see. So, all right. So let's jump in to some banking news. So, okay. First up, mortgage applications declined. So mortgage applications for new home purchases decreased a seasonally adjusted 4.4% for the week ending May 1st. FinCEN is going to update some due diligence frequently asked questions. So the Financial Crimes Enforcement Network reissued frequently asked questions regarding customer due diligence requirements for covered financial institutions. You know what? I will probably look those up and cover those on next week's episode, but stay tuned. More to come on that. So New York Fed survey, short-term inflation expectations rise. So households inflation expectations rose in the short term but remained unchanged at the medium and longer term horizons. Let's see here. Consumer credit increases in March. So consumer credit increased at a seasonally adjusted annual rate of 3.2% during the first quarter and 5.8% in March. Construction spending increased in March. So construction spending increased 0.6% in March and 1.6% from a year ago. So OCC, the banking system is sound, but cyber threats and fraud remain major concerns. So the OCC reported that the federal banking system remains sound, but cyber threats and fraud remain certain. And this was reported in its semi-annual risk perspective. And I'm sure I'll be doing an episode covering that report in the next week here. CISA issues agentic AI guidance. So the Cybersecurity and Infrastructure Security Agency and partners released guidance for organizations adopting agentic artificial intelligence systems. So CISA said the guide outlines security challenges and risks associated with agentic AI and provides actionable steps for designing, deploying, and operating these systems safely. This helps organizations align AI risk management with existing cybersecurity frameworks and strengthen oversight as agentic AI adoption grows. So, yes, very interesting. I'll probably try to cover that because I think there's probably some interesting things in that as well. ICBA offers to work with USPS on mail theft and check fraud issues. So ICBA said that mail theft and check washing schemes remain a persistent challenge for community banks across the country and offered to partner with the U.S. Postal Service to help mitigate the issue. So yes, that's a big check fraud is still the #1 fraud for banks, and no doubt that would help things out for sure. Factory orders rise in March. So new orders for manufacturing goods increased 1.5% in March. And then we get into the Bank Financial Officers Report, tighter standards for commercial and industrial loans. So this was according to what's called the SELUS. the Federal Reserve's latest offer of senior financial officers. So, what did they have to say? And again, like I said, I'll probably be doing an episode on this report so as well. But they basically said in the sluice that tighter lending standards for C&I loans remained unchanged. Demand for C&I loans to firms of all sizes. Unchanged standards and weaker or unchanged demand for commercial real estate loans. Unchanged or easier terms for almost all loan policies across CRE loan categories. Tighter standards and stronger demand across all non-depository financial institution loan categories. Unchanged standards and unchanged or weaker demand for most categories of residential real estate loans. Unchanged standards but stronger demand for home equity lines of credit. And finally, unchanged standards for credit card and auto loans and weakened demand for credit card, auto, and other consumer loans. Manufacturing activity expands in April. We talked about that. Regulators close Georgia Bank. We're going to talk about that in a little bit. Agencies issue host state loan to deposit ratios. So the federal banking agencies updated the host state loan to deposit ratios they will use to determine compliance with Section 109 of the Regal-Neal Act of 1994. Okay. Service sector expands at slower pace in April. New home sales jumped in March. The SEC proposes allowing semi-annual reporting by public companies. We talked about this over the last month or so. So the Securities and Exchange Commission proposed a rule that would give public companies the option of filing semi-annual reports in lieu of quarterly reports to meet their internal or their interim reporting obligations under federal securities law. So the Fed's Bowman agencies to host a roundtable. So the Federal Reserve Vice Chairman for Supervision, Michelle Bowman, said that the Fed, Treasury Department, and the OCC will soon hold a private or a public-private roundtable on fraud. So we'll keep an eye out on that. Finn said to hold a tribal forum on anti-money laundering and CFT proposal. So see what that brings. Okay, and then I've got some crypto legislation news. So a whole bunch of stuff basically happening this week. So first we start out with ICBA is reviewing revised legislative language on yield-bearing stablecoin. Now, ICBA is closely reviewing revised language on yield-bearing payment stablecoin released by the Senate Banking Committee members Thomas Tillman and Angela Alsobrooks as the panel works to advance digital asset market structure legislation this month. Now, what Angela and Tom Tillis, what they were referring to is actually they had made comments on the Genius Act. If initially, I thought they might have been talking about the Clarity Act, trying to get past basically the stalemate that has ensued on the Clarity Act. But no, this was going back to the Genius Act. So then we get this. So a couple days later, ICBA urges the OCC to strengthen Genius Act safeguards on stablecoin risks. So the ICBA urged the OCC to strengthen its proposed Genius Act rules to protect against the risk stablecoins pose to community bank lending capacity, consumers, and financial stability. So ICBA's recommendations in this letter, they want to minimize the negative impacts of stablecoins on community banks and credit to local communities. They want to minimize deposit flight and the impact on credit creation. They want to clarify key definitions to prevent regulatory gaps and protect end users. They want to establish strong consumer protection guardrails for payment stablecoins. They want to foster safety and soundness of payment stablecoin issuers. And they want to place appropriate operation limits on permitted payment stablecoin issuers. So, and then we go on to ICBA and others. New stablecoin language falls short on yield. So ICBA and other groups raised revised legislative language on yield-bearing payment stablecoins falls short of addressing concerns with the payment of yield and interest on stablecoins. So again, this is getting back to Tom Tillis and Angela. They basically said that Tillis and Angela are seeking to achieve the correct policy goal, prohibiting the payment of yield and interest on stablecoins, but the proposed language falls short of that goal. Research demonstrates that yield-earning stablecoins could dramatically reduce consumer, small business, and farm loans, making a clear and transparent prohibition essential. They will be sharing detailed suggestions for strengthening the proposed language with lawmakers in the coming days. And then finally, ICBA urges policymakers to pause new crypto policies. So ICBA called on policymakers to pause new policies on stablecoins, Federal Reserve master accounts, and OCC national trust charters to assess their combined impact on local communities and the broader economy. So in this brief, ICBA said policymakers should pause new policies on this trinity of crypto developments and reconsider the wisdom of attempting to fuel the U.S. economy with unaccountable crypto entities instead of well-regulated banks. These policies are front and center for community banks and the small businesses, farmers, and families they serve as policymakers greenlight changes that will undermine the foundation of the U.S. financial system. So, yes, I mean, they obviously, ICBA and a lot of the banking groups, they have been pushing back on these things for months and months and months. Even though that the OCC and the FDIC, they're giving deposit insurance, they're giving bank charters. The Federal Reserve is issued a master account to Kraken. So, a lot of this stuff is happening, seemingly regardless of all the pushback. So we will continue to keep an eye on that and see how all that plays out. So, okay, now I want to talk about real quickly for the next couple of minutes, just want to talk about all the episodes that I put out this week. So basically on Monday, I put out 2 more failures in private credit as Medallia and Affordable Care lose billions. So delinquent loans in the private credit market continue to go bad as we have 2 new problems. Medallia, a software maker, can no longer repay about $3 billion in loans. Affordable Care, a dental service company, is in the process of restructuring a $1.4 billion loan to Blackstone and KKR. Overall, delinquency in Blackstone's largest private credit fund has spiked to 2.4% in the first quarter of 2026. In other private credit news, Barclays is pulling back on riskier lending after an increase in losses, mainly related to MFS. UMB Financial outlined its private credit exposure. Family offices emphasize caution on private credit investments, and business development companies have used a law change in 2018 to increase leverage, sometimes in ways that are not visible. So again, just an update there on private credit. 2 more big losses. Obviously, they keep telling, all the big banks, everybody keeps telling us all these losses in private credit, they're all these one-off things. You don't have to worry about them. It's not a big deal. But yet the one-off things keep happening, and they keep getting bigger. We have now graduated from millions of dollars to hundreds of millions of dollars to now billions of dollars in loan payments. So this Medallia software company can no longer repay $3 billion in loans. Affordable Care is in the process of restructuring a $1.4 billion loan. So again, these problems are getting bigger and bigger. And as we are going to see here in a few minutes, when I get to our little private credit update for this week, HSBC has now found themselves in some hot water. So, but I digress. Okay, so then on Tuesday, I did an episode called Bank News, Name Changes, Banking Deserts, De Novos, M&A, AI Agents, and more. Now, what I tried to do in this episode was basically cover a whole lot of banking news that I just did not get a chance to cover in last week's live stream. So I figured I would just cover a lot of it in this episode and just put it out there. So in this episode, lots of news in the banking world these days. This episode covered stories about bank M&A, 1071 update, and new AI tools, de novos, and more. Wells Fargo is delving deeper into trading activity after their asset cap penalty was removed. Lending Club is changing its name to Happen Bank. Sezzle, a buy now, pay later provider, is looking to create a super app. Mission Lane applies to become a credit card bank. Oregon has created a new law seeking to increase de novos in the state. Fintech firm OpeFi is set to buy Arizona Bank. Mercury receives conditional UCC bank charter. Indiana Credit Union is buying an Ohio bank. Citi creates an AI-powered advisor for wealth clients called Citi Sky. Customers Bank is deepening ties with OpenAI to create faster commercial lending. Banner Bank to purchase Pacific Financial for 177 million. Fintechs are pushing a new law that would give them access to federal payment rails that include Fed ACH and Fed Now. The CFPB slims down the 1071 rule in a major win for community banks. So covered a lot of information in that episode. Like I said, if you want to just get some current bank information, that's a great episode to check out. So, and then on Wednesday, I did an auto industry update for May of 2026. So, Ford and GM are still recovering from major EV related losses, but Ford is seeking to create a midsize EV truck for a cost of $30,000. Meanwhile, dealer strips are struggling with supply shortages due to a lack of aluminum. Car makers are really counting on tariff refunds and service revenue to carry them due to a lack of sales. Despite these issues, local mom and pop car dealerships continue to consolidate, grow, and thrive. Used car values are seeing their highest point since the summer of 2023, with used EV sales really surging. 1 in 3 car buyers are now underwater on trade ins, with the average amount of negative equity reaching $7,214. The number of borrowers with negative equity has increased 42% over the last 5 years. A third of car buyers are reaching out 84 months to make the financing numbers work on new car purchases. Additionally, foreign automakers continue to dominate the sedan market, and Amazon is pushing into car sales. So that's your auto update there. On Thursday, I did bank capital raising in the U.S. is down 35.7% year over year. So U.S. bank capital offerings were down 35.7% from the same period 1 year ago, but increased 125.7% compared to the previous quarter. So on the equity side, there was a surge in preferred equity offerings, but this was mainly attributed to a large offering from Wells Fargo. Common equity offerings continued to be subdued. On the debt side, senior debt issuance was the largest component of 23.88 billion. However, this was the lowest issuance for senior debt in 3 years. Senior debt issuance increased 147% quarter over quarter, but was down 38% year over year. Subordinated debt issuance declined 26% quarter over quarter and 72% year over year. Still, debt issuance remains the largest component of U.S. banks' capital stacks over the last few years. Additionally, we reviewed recent examples of a capital raise from BayFirst Financial Corp and subordinated debt offerings from Fulton Financial and Renaissance Bank. So again, I thought very good. 2 weeks ago, I did an article on bank capital. Like what are the 5 questions that a bank should ask before raising capital? And this week I found that, like I said, I found this information on just capital raising in the U.S. and it was down in the different areas. And I just thought those 2 episodes were really good compliments to each other. So, and then finally, yesterday on Friday, I did Community Bank and Trust of West Georgia becomes the second bank failure of 2026. So Community Bank and Trust became the second bank failure of 2026 and the first bank failure in the state of Georgia in 10 years. Community Bank and Trust West Georgia was closed by the FDIC on Friday, May 1st, 2026. The bank had 288 million in assets as of December 31st, 2025. The Federal Reserve had ordered the holding company of the bank to bolster board oversight and increase its capital position in April. All the bank's deposits and some of its assets have been taken over by Anchor Bank out of Florida. This bank failure is expected to cost the FDIC insurance fund approximately 97 million. The first bank to fail in 2026 was Metropolitan Capital Bank and Trust in Chicago. So a little bit more information on that in just a minute. But those are the 5 episodes that I put out this week. Always encourage everybody to check that out. We, here on the channel, we do, for people that don't know, we do put out new episodes every Monday through Friday at 12 noon. Most of the episodes are usually pretty short in nature. I really try to keep these things to between like 10 and 20 minutes in length. Sometimes they do go a little bit over, maybe 23 or 24 minutes. But if they do go over, just rest be assured the information that's in there is really good. It's really good information. And that's why the episode might be a little bit longer. So don't be put off If an episode is, like I said, if it's 20 minutes, 23 minutes, don't be put off by that. I guarantee you it'll be well worth it because it'll be great information in there. So, okay. All right. So those were the episodes that went out this week. And now let's get back to our articles here. So I want to get into the AI conversation here. So basically the last couple weeks, just as a recap here, I went on a big I've gone on some big rants on AI, basically saying that the government is just there, they've got to rein this in with Mythos coming into play. That just changed the game. It changed the game, and now it's up to the government. The government they've got to rein the tech bros in. They got to rein the AI in. And there is some indication here, as we're going to see in the next few articles, that may in fact be the case. But let's see here. So we'll start off with this. So we started the week off, or I should say we started last week with top AI companies agreed to Pentagon deals for classified work. So contracts give Defense Department more AI options after it declares Anthropic a supply chain risk. So in other words, the Defense Department moved very quickly to strike deals with all these other AI companies to basically protect their most secret information. So the Defense Department has completed agreements with 8 technology companies, including many of the industry's biggest, to use their artificial intelligence capabilities in classified settings, boosting the Pentagon's efforts to gain access to cutting-edge AI tools. The department said Friday it is now capable of using in classified settings the technology and models from ChatGPT maker OpenAI, Alphabet's Google, Elon Musk's SpaceX, Microsoft, Amazon, Oracle, NVIDIA, and a startup Reflection AI. SpaceX owns Musk's AI company, xAI. While some of the companies, including OpenAI and SpaceX, had initial deals with the Pentagon, agreeing to have their AI tools used by the military in lawful scenarios, completing the contracts is an important step toward embedding them in day-to-day operations. So the deals show how much of Silicon Valley is agreeing to the Defense Department terms in a way that Anthropic didn't when it rejected the Pentagon's contract earlier this year and what spiraled into a months-long feud. The deals also highlight how the Pentagon is racing to incorporate AI into its systems. So, in other words, the government got in a fight with Anthropic, and to pay the government back for basically blackballing them because they wouldn't play ball with the government in some way. Anthropic said, okay, fine, you don't like that, we're going to drop Mythos on you, okay? And so now with Mythos coming in and being a potential game changer, and Anthropic threatening to basically release this thing, and with OpenAI getting ready to unleash something similar to Mythos, the Pentagon has scrambled to basically bring all these companies back in and basically tie them up and basically say, yo, guys, we're not going to do this, and we're going to take a different path here. So this is kind of step one. Now we go to step two. So White House officials discuss assessing AI models that pose security risks. Okay, so the aim is to protect consumers and businesses from potential cyber attacks by AI models prematurely released. Oh, okay. So the White House is weighing a new government review process for artificial intelligence tools that the government deems to pose cybersecurity risks, a move that could further expand its oversight of AI in response to Anthropic's powerful Mythos model. The White House is considering a cybersecurity-focused executive order that could include formalizing a government oversight group to create standards for the most powerful AI models, such as Mythos. People familiar with the discussion said. The goal is to protect consumers and businesses from cyber attacks and other disruptions caused by the premature release of such models, and a range of ideas are being considered. So finally, right? They're finally waking up. They're finally considering some of this stuff that they should have been considering months and months ago. This is common sense. This is common sense stuff here to say that, like, okay, yeah, AI. It can do a lot of good. It can also be a massive weapon for destruction. It just can. Would you let a kid play with a bomb in the street knowing that you could blow up the whole neighborhood? Like, obviously not. Like, so why would you let all these AI companies just running around doing whatever they wanted whenever they want, knowing that they can unleash something like Mythos upon us all? It's just crazy. So then toward the end of the week, now we get to this. So how Anthropic's Mythos threw the White House AI strategy into chaos. So administration's efforts to be involved in rollout of new models marks a shift. Now, what did I say last week? I said that I don't care about these companies. I don't like Anthropic, OpenAI. I don't care about their revenues. I don't care how much this is going to hurt their stock price or their quarterly earnings or whatever. I think now's the time where the government needs to step in and say, you're not going to release this stuff. And we're going to make this a matter of national security. You're not going to release it. And period. End of story. And furthermore, we're going to vet this stuff. Okay, as before you guys can roll this stuff out, we have to vet it. And if we find out you guys released it without vetting it, without letting us know what it is or what it can do, whatever, you guys are going to pay big time. You're going to pay big time for this because it's time to rein this in. So on a recent call with the heads of the biggest artificial intelligence companies, Vice President J.D. Vance was alarmed. Yeah, no, you know what. New AI models such as Anthropic's Mythos, which are capable of finding software vulnerabilities on their own, threatened to disrupt small town banks, hospitals, and water plants by starting cyber attacks that local governments weren't equipped to handle. Well, no, hold on a second. Hold on. They did not threaten to disrupt some small town banks. No. They called in the CEO of every major bank in the country. Let me say that again. They called in the CEO of every major bank in the country and they said, Houston, we have a problem. We have a big problem. And this Mythos could wreck every one of your banks, okay? And it could wreck it like within hours. So you better go back and start working on this. So that's what happened. And it wasn't wrecking a small town bank. This was talking about wrecking JP Morgan and Wells Fargo and Bank of America and US Bank. Just some tiny banks, nothing to be, overly concerned with. So, okay. Anyway, I digress. Okay, let's go on here. So, we all need to work together on this. Yeah, fat chance. Vance told chief executive officers, including OpenAI Sam Altman, Dario Amodi of Anthropic, Elon Musk, Sundar Pichai of Alphabet, so on and so forth. The April call, which followed a White House briefing that played a role in sparking Vance's concern over the latest AI model capabilities, set in motion a chaotic administrative response to Mythos that threatens to increase government oversight of AI and overhaul the administration's tech agenda. The concern expressed by Vance, paired with others, moves by the White House to get involved in the rollout of AI models, marks a shift from previous language about winning the AI race against China and removing barriers to deploying models. The White House is weighing an executive order that could create a formal oversight process for the most advanced models. Administration officials have asked Anthropic to hold off on expanding access to Mythos to more companies and organizations that manage critical digital infrastructure. The White House has tapped National Cyber Director Sean Cairncross to lead its response to the model, which could include other actions to address model safety or limit the ability of private companies to dictate how the government uses their tools. So, yes, so we'll continue to take a look at this. But let's see this for a second. So, new executive order under consideration has been cheered by proponents of AI safety. Yes, like myself, as a potential rebuttal of the hands-off approach led by the White House advisor David Sachs, a venture capitalist. People are treating this like some existential threat. Sachs said recently on All In podcast, which he co-hosts, "I don't think it is, as long as everyone does what they're supposed to do by using the AI tools to bolster digital security," he said. Now, this is where Sachs just totally loses me. It's like, no, Sachs. Like, I get that you're invested with all these guys. I get that you're going to make a ton of money with all these guys and all your AI investments. I get all that. But no, I don't trust the tech bros. I don't trust any of them. I think they're all a bunch of dirtbags. Elon, okay, Elon's all right, but the rest of these guys, no. I don't trust any of them. None of them have ever operated with the people's best interest. Okay, they've always operated with their own wallet in mind. You know, the more billions they can make, the happier they are. And they're all about, you know, disruption, disruption, disruption. Wreck it. You know, we'll dismantle it and we'll worry about it or fix it later. Well, no, I'm sorry. The AI in my mind is equivalent to the nuclear bomb. You know, you could create something that you could unwittingly unleash that could just wreck. You could wreck the world. I mean, this is not to be. This is not to be trifled with and taken lightly. And I'm tired of guys like David Sachs just dismissing this out of hand because this might hurt some of his investments. You know, like sorry, dude, like no. This has got to be handled with kid gloves. And if that means slowing down the tech bros, if that means hurting some of their, you know, earnings calls, all right, whatever, so be it. You know, I'm really not sweating it. And here's the thing with China. If you're so worried about China, just cut them off. No chips for China. Period. End of story. We could stop them. We could control this enough to stay ahead of them for years to come. All you got to do is cut them off. Call Nvidia and say, Nvidia, love you guys, but you're not selling nothing to China. And oh, by the way, and if you sell it to Taiwan and then Taiwan decides to give it to China, yeah, you're not going to be selling anything to Taiwan either. So you better double check and triple check your supply chains and find out where these chips are going. It's that easy. It's that easy. You cut them off. Period. And then you know, and Jensen Huang, he could go on and he could cry all he wants on CNBC all day long with his stupid leather jacket and be like, oh, you know, they're being so mean to me. They won't let me sell chips to whoever I want. Like, sorry, dude. Sorry. You know, this country, America, made you a billionaire, Jack. America did that, okay? China didn't do that, okay? Europe didn't do that. America did that. So you're going to put this country first. All right, sorry. I didn't want I didn't want to run off on my rampage, but I did. But anyway, all right, but I think this is a step, at least a step in the right direction. But I will say this, look, the tech bros, they aren't going to play nice in the sandbox unless you force them to play nice in the sandbox. The government is going to have to force these guys back to the table, and they're going to have to put some kind of restriction in place with this new executive order, but they're also going to have to put legislation in place. They're going to have to kick the House in the butt, or kick Congress in the butt, and get them to come up with some AI legislation to rein this in. It's just what's going to have to happen. Just because you can't trust these guys, you can't trust the tech bros. I'm sorry, you can't. All right, but let's go into a little bit more of the pure banking angle here on AI now, right? So banking's biggest names are talking about Mythos. So the Fed is considering effective supervisory approaches for Anthropic's emerging AI model. JP Morgan Chase CEO Jamie Dimon says he thinks people need a chance to assess and mitigate its risks. Yes, I would agree. Anthropic CEO Dario Amodei isn't shy to talk about his company's new artificial intelligence model, Mythos, including about its risks. But JP Morgan Chase CEO Jamie Dimon is calling on Amodei to release more details on the product so people can assess and mitigate those risks. The right thing for Dario and Anthropic is to lay it out, give people a chance to study it, understand the vulnerabilities, come up with plans so we can handle it. Dimon said of Mythos at a live streamed event Tuesday hosted by Anthropic. Mythos was designed to identify and eventually patch software vulnerabilities, but it presents a moment of danger in its exposure of such issues, Amodei said Tuesday. Last month, Anthropic decided against fully releasing Mythos to the public, lest it land in the hands of someone with ill intent. It was released on a restricted basis to some large tech firms on April 7th, and that day, Treasury Secretary Scott Bessent and Federal Reserve Chairman Jeremy Powell called an emergency meeting with big bank CEOs to discuss Mythos and its cybersecurity implications. Dimon, who could not make the Bessent Powell meeting, said Tuesday that cyber issues have been JP Morgan's biggest risk for years, and that AI made it worse. But he believes the cybersecurity risk posed by AI is a temporary thing, during this transitory period, he said. Mythos highlights the dynamic nature of AI and how quickly it can evolve. Fed Vice Chair for Supervision, Michelle Bowman, said last week at a Financial Stability Oversight Council roundtable. And yes, and we're going to get to that in just a second here. Jamie Dimon does this, live stream thing here with the CEO of Anthropic. And, he talks about, oh, well, they need to release it a little bit so people can study it or whatnot. Like, here's the Anthropic CEO who I think is a few nuts, loose of an engine. He's a wacky guy. And he shows up and he's all like, oh yeah, it's so great, it can wreck everything. And oh yeah, this is awesome. And we're going to release it, but we're told to hold off for the moment, but we can't wait to release it. And it's going to be great, and it's going to wreck everything at the same time. And you're just listening to this guy going, are you okay, dude? Like, are you on medication? Like what are you talking about? And then there's JP Morgan. Well, yeah, it's a huge risk and it's really caused us a lot of problems, and AI can really manage it, but it's okay. It's just a temporary risk in this transitory period. Like, Jamie is always, I love Jamie, but he's forever talking out of both sides of his mouth, forever. And it drives me nuts, dude. And it's like, dude, how much of a risk this is. Like, how this could wreck your bank. And yet there you are, like, oh, it's a risk, but it's manageable. We just need to play with it a little bit. It's like, dude, come on. Stop it. All right, now we go on to, now this is kind of a segue into Fed's Bowman confirms key bank meeting on Anthropic, signals regulatory shift. So Federal Reserve Vice Chairman for Supervision, Mickey Bowman, confirmed that top officials have met with the largest banks to discuss Anthropic Mythos artificial intelligence model, and said the new supervisory approaches regarding banks and AI may have to develop. Yes. The meeting, which reportedly took place on April 7th, was confirmed by Bowman during a May 1st speech at the Financial Stability Oversight Council roundtable on AI, cybersecurity, and risk management. Bowman used the revelation to underscore the urgent need for coordination across government as AI tools rapidly evolve beyond initial expectations. This type of discussion is extremely beneficial to ensure the protection of the banking system, Bowman said in prepared remarks, referring to the meeting between big banks and Fed Chair Jeremy Powell and U.S. Treasury Secretary Scott Bessent. Anthropic's Mythos, an AI model specifically designed to identify cyber vulnerabilities, exemplifies both the promise and peril of advanced AI. While the tool enables financial institutions to detect and patch security weaknesses more efficiently, Bowman warned that the same capability could be weaponized by malicious actors to exploit those vulnerabilities. As we learn more about this tool and others to be released in the coming weeks and months, we will continue to consider effective supervisory approaches for these and other emerging capabilities. Bowman signaled a significant pivot in how U.S. regulators will oversee AI in the financial sector. In April, the Fed, alongside the Office of the Control of the Currency and the FDIC, amended its model risk management guidance to explicitly exclude generative and agentic AI. The revised guidance now applies narrowly to traditional bank models and basic AI applications, acknowledging that rapidly evolving technologies require different approaches, Bowman said. So the Fed is working to update and simplify its third-party risk management guidance to reflect actual and future risk, which Bowman criticized as having been vague in its scope and application for too long. The goal is to ensure that supervisory guidance does not become a barrier to innovation. Yes, of course. I again totally agree with that. And then we go into investors urge community banks to increase efficiency with AI. So investors are urging community banks to implement artificial intelligence in back office tasks, warning of obsolescence if AI is not utilized. Using AI to streamline stare and compare or repetitive and painstaking tasks and allowing employees to spend time doing more valuable work can help community banks level the playing field with larger banks and fintechs. Claros Capital Managing Director Kevin Stein said during S&P Global Market Intelligence's Community Bankers Conference on May 7th. Community bankers need to familiarize themselves with AI tools and understand their strengths and weaknesses, Stein said. Everyone at every bank should at least be taking an intro course, Stein said, speaking about AI. And I would tend to think that at least half of every bank staff doesn't really understand it. C-suite bankers can misunderstand how AI is best utilized at the community bank level. Stonecastle Partners LLC chairman and CEO Joshua Siegel said they often want to use AI to find new business, which is not the best use case for the technology, but AI can help free up employees to do business building work, he said. By using AI to do repetitive tasks such as internal and regulatory reporting, employees can focus on generating new business or managing risk. So again, so interesting here that, again, now you got investors basically put on the one hand, you got the Fed basically saying like, hey, we're probably going to have to clamp down on this a little bit and basically come back with a lot more guidance as to how banks should be using generative and agentic AI. And basically now you've got on the other end of it, you've got investors saying, well, wait a minute, we need you to speed up your AI usage because we need you to use it for more efficiency. Make your bank way more efficient than what it currently is so that you can spend more time out there doing more sales, increasing business, so on and so forth. So, and let me see, is this the last one I had? Yeah, this is the last article on AI here. So Anthropic and FIS are built. Now, for people that don't know, FIS is one of the big core providers for banks in the country. They're one of the big three, along with Jack Henry and Fiserv. So Anthropic, and then when I say core providers, for anybody that doesn't understand what that terminology means, so the core, so every bank in the U.S. uses what's called a core operating system, and like I said, the big three providers of that are Jack Henry, Fiserv, and FIS. The three of those companies probably have about 70% of the marketplace for core operating systems for banks. So Anthropic is working with basically one of the big three, FIS, and they are building an AI agent to help banks police financial crimes. So AI Giant strikes a partnership with financial software provider FIS to develop new tools for banks. Now look at this guy. I said he looks a couple bolts short of an engine, and I was not joking about that. An AI bot may soon be policing millions of bank accounts for financial crimes. Oh boy, I can't wait. Anthropic and FIS, otherwise known as Fidelity National Information Systems, the financial software provider that underpins a swath of the financial system, on Monday announced a partnership to develop new artificial intelligence tools for banks. So the companies have agreed to build AI agents, programs that complete tasks without the supervision of a user for use by financial institutions. The agents will draw on FIS's financial data and systems and Anthropic's AI Claude. Shares of FIS rose about 7%. Of course, they would. The first tool being developed is an AI agent to investigate drug traffickers, terrorists, and other criminals that use the financial system. The FIS will also be used to explore, investigate every American, regardless of how much money you keep in the bank. Oh wait, no, sorry, I added that last bit. That was me. I was not actually in the article. But am I wrong? Ask yourself that question. Am I wrong? Maybe not. Bank of Montreal, an amalgamated bank, will be among the first institutions to use the financial crimes agent, Ferris said, and is expected to be widely available to clients in the second half of the year. Anthropic engineers have been embedded within teams at FIS already. Jonathan Yeager-Hyman, Anthropic's head of industries, confirmed. Ferris said the financial crimes bot would be able to independently amass evidence for potential cases, transactions, account information, and other data that can be spread across several sources, leading to significantly less cost and time per case. Human investigators will still make the decisions about cases, she added. The contest. So banks spend billions a year on anti-money laundering efforts, often with sprawling teams and software meant to root out financial crimes. Those efforts are required by U.S. federal law and supervised by regulators. Trump administration officials have pledged to make changes to money laundering supervision, emphasizing the highest risk issues and shying away from the nitpicky technical compliance. Advances in AI models have triggered fears on Wall Street that many kinds of software could become obsolete. Anthropic, with a product announcement earlier this year, sent markets reeling. Investors have worried that companies in the future will opt to make their own software using AI tools rather than buy it from providers. FIS is one of those companies whose stocks were hit by those fears and is down more than 25% this year. So, the FIS Anthropic partnership, one of many the AI lab and its rivals have signed to develop industry specific tools, shows how, in many cases, AI tools can plug into and accelerate work being done by software that enterprises are already using. So, yes, so just very interesting, and we'll keep an eye on that. So, to kind of quickly recap the AI conversation for tonight. So, basically the government is starting to make a little bit of U-turn. Mythos was the wake-up call to basically say, wait a minute, we can't let we can't let the tech bros run wild out there with this AI stuff. Banks are really starting to wake up to the threat after the big meeting on April 7th with Scott Bessent and Jeremy Powell. And Michelle Bowman there is basically giving you that hey, regulators, we now need to get a little bit more serious about looking at a lot of this stuff and really looking at how banks are working with a lot of these third-party vendors. And now you've got Anthropic, who, again, the creator of Mythos, is now partnering up with FIS to unleash new AI agents all around to basically police financial crimes. So yeah, it's like I said, I would be remiss if I said I wasn't a little worried about this. Okay, I really would. But like I said, we'll keep an eye on all the AI stuff and we'll see what happens from there. So, all right, let's switch gears now. This article I have done a number of episodes on prediction markets in the last over the last couple of months, and I saw this and I just started shaking my head because I was like, yep, I was like, I knew it, it's like a casino, man. The house always wins. The house always wins sooner or later, and even if you win money, sooner or later they're going to take it all back. Okay, and so almost everyone loses except a few sharks on prediction markets. A Wall Street Journal analysis shows a small number of accounts on Polymarket and Kalshi, often pros, using data-driven algorithmic trading, take home most of the winnings. So John Peterson, 33, couldn't work. The former Outback Steakhouse line cook was recovering from a car crash and running out of money. Kalshi, the prediction market, promised a quick way to fix that. He took out a variable interest loan and started betting. You already know where this is going. At first, it worked. Peterson turned about 2,000 into close to 8,000 by betting on daily snowfall totals in Detroit, where he lived. He parlayed that into 41,000 by trading on sports, using a strategy he developed with the help of AI, according to a Wall Street Journal review of his account records. Then he placed his most audacious bet yet, all 41,000, that a celebrity would say a particular word on TV, and he lost it all. Peterson isn't alone in walking away empty-handed from the bet on anything markets, which cover sports, celebrities, news, and more. Kalshi's and its competitor, Polymarket, advertise themselves as life-changing tools for regular people. They all do, implying everyone has a fair chance to score. Of course you do. I was about to be unable to pay my rent, but I got 2 years of rent through Kalshi's predictions, gushed one woman in a Kalshi ad on TikTok. But for most users, the reality is nothing like that. It never is. Instead, casual traders are bleeding cash, while a small number of sophisticated pros, including trading firms with access to vast streams of data, eat their lunch, according to a journal analysis of platform data and interviews with traders. On Polymarket, the journal found 67% of profits go to just 0.1% of accounts. That means less than 2,000 accounts netted a total of nearly $500 million. The journal analyzed 1.6 million Polymarket accounts that have traded since November of 2022. There are at least 2.3 million total accounts on the site. So let me say that again. 2.3 million total accounts on the site. The Wall Street Journal analyzed 1.6 million of them and found that less than 2,000 accounts took home nearly $500 million. Okay, they took home 67% of all the profit. On Kalshi too, Losers vastly outnumber winners. Spokeswoman Elizabeth Diane said there are 2.9 unprofitable users for each profitable one based on data from the past months. She said the number is subject to change as the exchange grows. The company doesn't make public comprehensive data on users' profits and doesn't share its total number of users. Total trading volume on both platforms has skyrocketed to 24.2 billion in April, up from just 1.8 billion a year earlier, according to analytics firm The Block. Proponents say the markets don't count as gambling. Yeah, sure, okay. And they harness the wisdom of crowds to accurately predict future events. Yeah, you gotta love it, dude. I'm getting, it's late on a Saturday night here. I'm getting delirious. Um, Federal Reserve research shows Kalshi is an effective tool for forecasting economic trends. Okay, maybe. Okay, maybe. But I just wanted to point this out. This is I said that this was going to happen. I said that this was going to happen. That all this was going to do was get people addicted to gambling. This poor guy. This poor guy. He's out of work. He got busted up in a car crash. He's running out of money, and yet somehow he goes in and he takes out a loan. He's got no job. He's out of work. He gets a loan with a variable interest rate on it, and he starts gambling. And make no mistake about it, he is gambling. He starts betting on weather. Then he starts betting on sports. Then he starts betting on whether some celebrity would just say a word on TV. I mean, that is pure gambling at its finest. And what happened? He lost it all. And now he's left with a loan, undoubtedly, that he's got to pay back now with no job. And this is the damage that the vice of gambling does to people. And like I said, and this is only the beginning. It's only the beginning. You are only going to hear more and more stories, horror stories like this. And I don't know where the end of this. I don't know where the end of this is. I just know that this is a really bad thing, and I'm sure that as the lawsuits pile up, as things come to fruition, these guys will probably be dramatically reined in. But the reality, like I said, is that there is a ton of money to be made right now. Everybody wants to get in. Robinhood got in on prediction markets. Coinbase wants to get on prediction markets. Wall Street trading firms like Susquehanna, a whole bunch of others, they all have gotten in on. They all want to get in on prediction markets because they all see a ton of money to be made. And obviously those pros are the ones making all the money right now on these prediction markets. So again, it's sad. I mean, it really is sad to me because I could see this. It's like a train wreck you see coming, and it's just terrible. But anyway, all right, I want to get to a couple other things here. So Georgia Bank, Community Bank and Trust, West Georgia's basically failed, first bank in Georgia to fail in nearly a decade, second bank in the U.S. to fail this year. Like I said, I did a whole episode on that yesterday. So if you want to go check that out, please go check that out for more information on it. I go through this whole article here, talk about all this, the numbers, other banks that failed or whatever. So definitely go check out that episode if you want more information on that. Here's what I wanted to get to, though. This failed Oklahoma bank's ex-CEO pleads guilty to bank fraud. Now, this was for the First Bank of Lindsay. So their CEO, Danny Siebel, faces up to 30 years in prison and a fine of up to $1 million. So the former CEO of now failed First National Bank of Lindsay pleaded guilty to bank fraud Wednesday and now faces up to 30 years in prison and a fine of up to $1 million. Danny Siebel, who led the bank from 2007 until his termination in September of 2024, oversaw the issuance of loans to at least 3 borrowers, his personal friends and neighbors, which were never repaid, the Justice Department said in a Thursday press release. He manipulated and falsified numerous bank records to overstate the performance of these loans, including by new loans or bank funds to cover overdrafts and outstanding loans, the DOJ alleged. On or about March of 2020 through September 20th of 2024 in the Western District of Oklahoma, I knowingly executed a scheme to artifice to defraud the First National Bank of Lindsay by means of false or fraudulent pretenses, representations, or promises, Siebel wrote in his guilty plea petition on Tuesday. First National Bank of Lindsay was FDIC insured, and I acted with intent to defraud it. My fraudulent actions were capable of influencing the decision of the bank, and I placed the bank at risk of civil liability or financial loss, he wrote. The Office of the Comptroller of the Currency shuttered the bank in October of 2024 after identifying information suggesting fraud that revealed depletion of the bank's capital and referred the case to the DOJ. While not all borrowers were aware that Siebel failed to record their loans or made false entries about their loans and bank records, others directly requested that Siebel fix or manually add funds to their accounts when they needed money, according to a December indictment. So again, this is just another crazy story. And I did cover a lot of this in the episode that I did on the First National Bank of Lindsay. Again, if you want to go back and watch that episode to get more details on this whole bank failure and fraud incident, this is just the confirmation of what we suspected happened. I mean, this guy basically created fake loans that he gave to friends and business associates that he favored, and then basically made new loans to pay off the fake, made new fraudulent loans to pay off the fake fraudulent loans, and basically did this over a number of years until finally the whole thing, eventually, as it always does, blew up in his face, and he killed the bank. Now, he came in, he pleaded guilty, obviously because he had to. He had no choice. They probably had so much evidence against him, and he probably had people that testified against him that basically, yeah, he's just toast. So again, interesting conclusion, interesting wrap up to, again, this failed Oklahoma bank, the Danny Siebel from the First National Bank of Lindsay, guilty on bank fraud charges. So again, let's see here. What else? I'm going to have, I'll save this for next week. I'll come back. I've got a bunch of private credit and some other stuff in here. I'll come back to that next week in the next week's live stream. But what I'm going to do, I'm going to wrap up right now, though. So I'm going to go into a wrap up mode, and then I'm going to I'm going to do our story of the week and our quote of the week. So let me get my banners ready. Hang on a second. Let me get my banners up. Okay. All right. So if you are watching the podcast on Apple, Spotify, on Apple Podcasts or Spotify, please make sure to leave me some reviews, as that really, really helps the channel. Remember to visit the website, thebankernextdoor.com. A lot of great things up there on the website. Make sure to subscribe on YouTube if you want the latest and greatest updates via posts and messages. Make sure to send any comments, questions, or recommendations to info@thebankernextdoor.com. That is how you reach me, at info@thebankernextdoor.com. You can follow me on social media. I am up on Getter, X, and Truth Social. I will tell you I probably spend the most of my time on X, but you can follow me on there. And make sure to just follow the channel. What else can I say? Just remember that we are on YouTube, Rumble, and all major podcast platforms. We have new episodes every week, Monday through Friday at 12 noon, and at the BND live stream. Strategy Room is on every Saturday night at 8 o'clock here on YouTube. And soon, I know I've been saying that for months, soon to be coming to other platforms. I will be up on Rumble in the not too distant future, and also hoping to be up on X as well. So, okay, that being said, let's go to our story of the week. So this week, I'm doing tangible common equity, also known as TCE. So tangible common equity is a measure of a company's physical capital, which is used to evaluate a financial institution's ability to deal with potential losses. Tangible common equity is calculated by subtracting intangible assets, including goodwill and preferred equity, from the company's book value. Because TCE is a measure of a financial company's equity, and in a volatile stock market, that's a good thing to know. Tangible common equity shows how much equity owners of a company's common stock would have if that company were liquidated. TCE is what's left when you subtract a company's intangible assets, goodwill, for example, and its preferred stock, whose owners are paid back before owners of common stock in a liquidation, from its total assets. A low tangible common equity ratio indicates that the company could be over leveraged. So, yes, so that is tangible common equity. So, okay, and then now let's go to our quote of the week. So, this comes to us from Johann Wolfgang von Goethe, and it goes like this: It is the great triumph of genius to make the common appear novel. Yes, I love that from Goethe. Just a great quote there on, how genius just makes the common appear novel. Just a great thing. Elon Musk has done that time and time again to his credit. So, all right. With that being said, I thank everybody for watching. I thank everybody for listening. I thank you for hanging out with me here on another Saturday night. I hope everyone has a great weekend out there. Happy Mother's Day to all the mothers out there. Mom, I know you're watching at home. Thank you very much. Have a happy Mother's Day out there to everybody out there. And like I said, come back next week for another episode in the strategy room. Until then, have a great weekend, and I will see everyone again real soon.